Okay, so you can just about see my smiling face there. So my name's Dave Saddington. I joined the Growth Hub in May of this year. So I'm what's known as a business growth support advisor. I've had a very long career in business banking and alternative finance. So I am the first port of call when it comes to the business finance specialist, but we've got a team of advisors who can help, and I'll come on to the more details about that later on. Next slide, please. Oh, hang on, wait a minute. No, go back, sorry. So what my sessions are going to cover: an introduction to the Growth Hub, what is investment finance and angel finance, and then we've got specific sessions, one on angel finance from GC Angels. Then we've also got a session from investment finance with Maven, and then we've got a real live business with Aerocloud, George is going to go through how he actually raised the finance for his business. And then last but not least, we'll have the panel Q&A session, which will be hosted by my colleague and join the Growth Hub at the same time. That's Sherry Semper. Next slide, please. Okay, a bit about the Growth Hub. You can see quite a few smiley faces again there, and really it's a free and impartial service funded by the government, and I must reiterate it is a free service, which I think in this day and age is a great offering. We're part of the Cheshire and Warrington. There's Cheshire East, Cheshire West and Chester, and Warrington local enterprise partnerships. So we cover businesses that are located in that area. We work with over 200 partners, and we've obviously got a couple of them on today, that being GC Angels and Maven. And we work with businesses no matter what the size or the sector. Our service is bespoke to you and your business needs, and we provide a range of services that can help the business grow. And what we do basically is we will do a diagnostic at the beginning on our first contact, and then we will decide where we go from there. So we've covered coronavirus issues, exporting, finance, growth, HR, innovation, peer networks, skills and startups. So I think that pretty much covers all aspects, but there might be some other need, but please get in touch with us and we'll give you details of how to do that later in the show. Next slide, please. Okay, these are the contact details, and again, these will be shared, so you don't need to scribble away and copy them down now. We will get these across to you. But we've recently revamped our website, so you can have a good look on that, and there's a contact link to get in touch with us. It's simple as that. Next slide, please. Okay, what is investment and angel finance? So this is my bit to just give you a little bit of more context about myself. I joined in May of this year. It seems like I've been here for a long time. I'm doing a lot of work at the moment on helping businesses access the recovery loan scheme or the government support schemes, but obviously today we're focusing on investment. So I would be a point of contact in the growth team. Okay, next slide, please. Okay, a bit about what I would cover and what I would consider to be important on investment finance and angel finance. So in a nutshell, it's access to capital, i.e. cash, into the business. And we've all seen the programs on the telly, but you know, you don't just put cash in and get nothing out of it. What the investors will be looking for is a return by way of equity or stake and shares in the business. So we've got two different types of investors today on our program. We've got an institutional investor, that being Maven, and obviously they'll go through the details of what they offer in their slot. And we've got individual investors, which is access to an angel network, which is GC Angels, which will be our first session on today, which will be access to individuals who are probably like-minded individuals who've made money, hopefully from an existing business, and they're happy to invest in a similar type of business and add value. It's also important to have access to professional advisors, and I'll be asking about who your accountant is. If somebody says, well, I haven't got an accountant, could you advise? We can advise, we can't be specific and give details of one specific accountant, but we can help you along those lines to find somebody. And also on the legal aspect side, you'll need to know how you're going to set your business up, and the tax advantage around that. So that's why you need access to an accountant and a legal advisor. Okay, you'll also need to have consideration about your valuation, because if you're discussing somebody putting money into your business, then you're going to have some format of how you've valued the business. Early stage businesses are very difficult. You've got to look at comparative types of businesses, but also you've got to consider what your future outcome is going to be as well. What's your aim? You're aiming to exit the business in 3 to 5 years' time with a buyout from a bigger business, etc. You need to think about that at very early stages, and also in your negotiations with any investors. So it's an opportunity to bring experience into the business, and somebody who's going to add value to your business as well. Next slide, please, Tom. Okay, you can tell this in the first bit. This is my banking background, but these are important considerations and would be covered off in any diagnostic that I complete with you. But to give you an example, you might have the best idea in the world, a fantastic product. We've not put hardly any money into it. Maybe you've just put your time into it, which has obviously got a value to it. But you've also got to think about what your skin in the game is. What have you put in? What have you got at risk if the business fails? And that is important. And one consideration that we can cover, and it is a partner of ourselves in the Growth Hub, is the startup loan scheme as being one alternative to raise other finance. You can raise up to 25,000, obviously subject to approval, 25,000 per person, and a maximum of £100,000. So that would obviously be for 4 individuals, 4 directors or shareholders that are putting money into a business. Your business plan, in my opinion, should be simple summary of key points. I've seen business plans run for 50, 60, 70 pages, and quite often it's too much. You've got to think about how you're going to present your business idea in a clear and concise manner. And again, it's very easy to get examples of business plans. And indeed, if you applied for a startup loan scheme, you'd be expected to actually put a business plan together, and they've got templates that you can use as well. Your pitch deck is your opportunity to present your business plan, your business idea to potential investors. And a bit like we're doing sessions today, I think you've got to be used to thinking you're only going to get 10, 15 minutes to present your business through a pitch deck. People can spend quite a bit of money putting, a really jazzed up pitch deck together. But really what you need to do is think about how you're going to present that in a very, very simple and easy to understand way to potential investors. Financial projections are absolutely critical to any business. It doesn't matter how long you've been trading, you should have financial projections, at least covering probably for an existing business the next couple of years. But typically for a startup business, you've probably been asked to project to 3 to 5 years. And last but not least on my bit, I think the guys may well cover this in their sessions, but we've got SEIS and EIS, which is Seed Enterprise Investment Scheme, or the Enterprise Investment Scheme. Seed is for startup businesses, but basically what that is, I'm not going to go into full details on this, but we can get experts to talk to you about this as well. But that is really giving tax advantages and tax benefits to anybody investing into a business to make your business proposition more attractive. So that's my session completed today. If you go on to the next slide, please, Tom. What I'd like to do now is introduce you to GC Angels and Sarah Ayton, who's the Strategic Relationship Manager representing them today. GC Angels brings together angel investors and an advisory service to support innovative and high growth businesses in the North. And I'll hand you over to Sarah, and I'll mute myself for the time being. Over to you, Sarah.
Hi, good morning, everyone. Thanks for the introduction, Dave. Great to speak to you all today. So if we could have the next slide, please. Thank you. So I'm just going to go over briefly what we do at GC Angels, how we could work with you, and getting investment ready. Next slide, please. So GC Angels, we're a part of the Growth Company. There are a number of different businesses within the Growth Company group supporting people across the Greater Manchester region, but also a little bit further out, covering Cheshire and Warrington, also parts of Lancashire. So what the Growth Company does covers education, skills, employment, and what we do at GC Angels, we support businesses, early stage businesses across the Greater Manchester region, again, including Cheshire and Warrington and a bit parts of Lancashire, to gain investment, equity finance, and also support and networking that they may otherwise not have. So we currently have a network of over 300 investors or funds on our portal that have access to the businesses that we've worked with and supported. We do also have a fund that we can directly co-invest with into our businesses. Next slide, please. So we were previously named as the most active early stage investor across Manchester, and that's always a good feat to have. So next slide, please. Thank you. A little bit about our portfolio. So we've currently worked with 50 deals, delivering over £30 million to the market. We have a high concentration of female investors, female entrepreneurs that we work with. We're a founding member of Fund Her North. So we're very driven by ensuring that there's a lot of diversity in our businesses and ensuring that everyone has similar opportunities as much as possible. Again, looking at this, we've got 30% of our funding businesses with female founders versus 10% nationally. And our key sectors that we invest in are technology, digital and creative, and some life sciences as well. But again, tech and digital are pretty broad. So there's a lot of businesses that we are able to work with. Next slide, please. So now I'm going to go into why you should seek investment, what kind of investment there is. Next one. Next slide, please. Thank you. So the kind of finance funding that GC Angels will support is equity finance. So investors, angel investors on our network will invest a portion of money for a portion of equity within the business. This can depend on the amount of the value of the investment that they make, but also the type of business that they're working with. Other equity finance can include VCs and private equity. Next slide, please. Thank you. So what is an angel investor and how are they different from VCs? Next slide, please. So looking at this timeline, we will work with businesses at a pre-seed stage or a seed stage. The value of the money has more significant of an effect because it's an earlier stage, there's a higher risk on the returns that an investor may potentially be able to receive. Next slide, please. Thank you. So going back to what Dave mentioned about having an investor deck, one thing we do is we're able to support you on getting your deck and your presentation investor ready. We'll make sure you cover all the aspects that an investor would be looking for when they're listening to your pitch and looking at the business, conducting due diligence to see whether they would be able to invest in your business. The investment deck should cover finance, team, competitors, and a lot of other things that Dave will be able to support you with if you have any concerns or queries. But again, we are available as well. So if you did have any questions, my email address is at the end of this slide. Next slide, please. Thank you. So finding angel investors. There are a lot of different methods that you can find angel investors. One, going through Dave, going through us. We have a network of over 800 investors on our portal. Like I said previously, that will be able to look at your pitch deck if engaged with us. There's also the UK Business Angel Association, who may be able to put you in touch with relevant parties, but also give you support and information about what you should do, how you should get investor ready, and how to make yourself more prepared for, going forward. Working with other angel networks, co-investment funds, and also business growth hubs. Thank you. Next slide, please. The main thing is when you are pitching to angels and when you're pitching to us and everyone else around you, you need to be yourself, because it's your character that sells you, not only the business idea or the proposal that you've got, it is who you are and the determination, the motivation that you've got and you can put across to the people. Next slide, please. Thank you. So that's the link to our investor portal. When we receive your pitch deck, if we believe that we are able to work with you, so the way we would work with you is we would use our network to support you, being other investment partners, be it other boards where they'll advise and support you by, looking at your deck, improving it, putting you into new networks, ensuring you have the best resources possible to actually succeed. Next page, please. And I think that should cover the majority of what I've said. If you do have any questions or if you would like any further information, please either go through Dave or my email address for direct contact is absolutely fine as well.
Okay, brilliant, Sarah. Thanks very much for that.
Whistle stop tour.
Yeah, very, very informative, and you know, we've got a lot of information there. So thanks very much for that. You can now sit and relax while somebody else takes over.
Thank you very much.
If Tom could pass us on to the next slide, please. Okay, we've got. I was calling them Ant and Deck before, but I don't think they'll appreciate me doing that. But we've got a partnership doing this one, so I'm really looking forward to how these guys are gonna present as a duo. But we've got Gavin Bell and Dean Cox. They're both senior investment managers, and that's part of the Northern Powerhouse Investment Fund, Maven, and I'm sure they'll cover that off in their presentation. But basically, they provide a flexible funding options to accelerate business growth. And without further ado, I'll pass you over to Gavin and Dean.
Thank you very much, David. I'll kick us off and just kind of talk through a little bit about Maven generally, the MPIF fund, and some of the key stats in the Cheshire and Warrington area, and then pass on to Gavin, who'll talk you through kind of our investment process and some of our recent transactions as well. So Tom, if you could go to the first slide, that would be great. Or the next slide. Second slide. So in terms of Maven, a little bit about Maven. So Maven is a spin out of the old Aberdeen Asset Life fund business about 11 years ago, based in London. So we've got offices right the way from London up to Aberdeen and across all the regions, 11 offices in total now, very much a kind of a regional private equity house. And what that means for Maven and Maven client funds is we've got a very diverse number of funds to deploy. So I think it's probably important to understand what types of funds that Maven manage initially. So we've essentially got two pots of funding in essence. We've got growth funds and buyout funds. So in terms of the growth funds, we manage regional mandates for the British Business Bank, and one of the ones that we're here to talk about in particular is the Northern Powerhouse Investment Fund, which I'll go into in a little bit more detail shortly. And basically what we're looking for with MPIF is early stage businesses in the north of England whose funding will be looking to create jobs in the region and stimulate growth, economic growth across the region. We typically write checks anything from 50k up to 2 million. The average check size is around 750k. And like I say, they're very much early stage businesses. And then we have on top of that fund is our Maven VCTs, which are for more mature businesses, kind of more at that Series A stage. So again, still looking for growth, but we're typically looking for businesses around the kind of $1 million ARR mark and above. And we typically invest anything from 1 to 5 million in those businesses. And then the other funds that we do have are buyout funds, but it's probably not appropriate to dwell on those today on today's call, because I think the focus is around MPIF really more than anything else. So I'll move on to the next slide if that's okay, Tom. So in terms of MPIF, as I said earlier, then it invests in anything from 50k up to 2 million in suitable SMEs. And when we say suitable SMEs, what we're looking for there is businesses in the northwest. So that caters right the way from Cheshire up to Cumbria, across to Leeds, and we're looking for businesses that are no more than 7 years old, or if they are 7 years old and above, they'll be looking to launch new products into new markets. So it's really kind of focused on growth, early stage businesses in the region, focusing on creating jobs. In terms of Maven as a fund, we're sector agnostic. So, we don't profess to be manufacturing, technology, retail specialists. We generally will view a business on its merits and on the sector on its merits at any one particular time. And I think what we've learned as an investor over the years is that actually a lot of the problems that businesses face, those growing pains, particularly the early stage businesses, are all the same. It doesn't matter what sector they're in. I think there's always that nuance. There's around probably 1% of the problems are sector specific. But what we do then is leverage into Maven's existing network. So, we've got, like I say, we've got 11 offices throughout the UK. On average, we've probably got 10 people within those offices. So we've probably got about 100 investor professionals who all have their own networks. And what we do is look to leverage off those networks to really help our portfolio companies. And we also encourage our portfolio companies to talk to each other. because often, you know, there's nothing better than entrepreneurs talking to each other about the problems that they're encountering in their business, and kind of really encourage that community feel. If you could go to the next slide, please. In terms of MPIF coverage, I think we've obviously already covered the region. So, you know, like I say, up from Cheshire all the way up to Cumbria and across the Leeds. So within that region, you also have Liverpool, Greater Manchester and Lancashire. We've got an 82.1 million of coverage at the moment with MPIF. In terms of Maven generally, we've got just under £1 billion of assets under management. So that kind of really does show that, you know, we are in the game of deploying capital and deploying growth capital in particular. Next slide, please. In terms of the current MPIF overview, we've deployed 50 million of capital already to date since we've had the funding since the back end of 2016. We've invested in 62 companies in the north. And we've created 855 jobs, and we've also achieved private sector co-investment along many of our investments to date. As an investor, we're quite keen to co-invest with other funds or other individuals. GC Angels is a business that we've also worked with as well. I think the view on that is actually, you know, sometimes it's good to have more people around the table who can offer different views and, you know, leverage off their networks and really help the businesses to grow. I'll pass on to Gavin now to talk a little bit more about, I know he's got some more specific stats in the region, and also to talk through the investment process.
Yep, thanks, Dean. Good morning, everyone. Yeah, I work alongside Dean in the Manchester office for Maven, where there's about 20 of us now, I think. So one of the bigger offices of Maven, just shows our commitment to the Northwest and running this Northern Powerhouse Fund. So if we could move to the next slide, please. So just some stats. So Dean gave you the overall fund stats there, just in terms of Cheshire and Warrington. We've invested 10.5 million across the region since we started the fund into 10 different companies. It's important to say that those companies, we've probably done multiple rounds in most of those. So we'll put the first check in and we'll often follow. I know some of mine we've done 2 or 3. We've created over 160 jobs, which is great news in the region in that past 4 years. And whilst we've invested, we've got 44 million of investment alongside us as well from angels or other investor groups. Could be strategic investors or other VCs. So that's really good. So we're attracting a lot of investment into the region alongside us as well. And just at the top there, we've got 31 million roughly to deploy still. So yeah, plenty of dry powder for more investments over the next couple of years. Next slide, please. So I'll just walk you through the investment process. I think it's important to say, you know, some processes can be, as it says on the left-hand side, can be six to 10 weeks. I would say allow probably 3 months from start to finish. You know, some parts of the deal are sometimes longer than others. Just depends on the specific deal. Some will get done in 6 to 10 weeks. Some we might talk to businesses for a year, and they might come back, and then we might do a deal. So yeah, there's no hard and fast rules on that. It's a 2-stage process really. So we do a lot of work up front, and to do that, we'll need a business plan, a good business plan, like Dave says, nothing too lengthy. You know, 10-15 pages is perfectly adequate. A good set of forecasts so that we can look at your cash runway. So how far will this funding take you? What milestones will you be looking to hit? And typically we want to fund 18 to 24 months of runway at least, really. Because if we start funding 12 months, any hiccups, and that could easily become 6 to 9 months, which is too short to you know, to be able to take your product to market and increase your sales. So we always look at least 18 to 24 months of funding. In terms of, the process is quicker, the more organised management teams are. So when I talk about that, this sort of information we'll need is the business plan, the forecasts, financial forecasts. We'll need to understand the strategy. And then as we move through the deal, we'll need the more detailed information like customer contracts and the cap table, the shareholder table, and things like that. So as I said, two-stage process. We do an initial investment committee where there's usually 4 or 5 partners that we air the deal to and present the deal to. If that's successful, then we can then offer heads of terms, which would be the key terms that we could offer for the investment. And then we move into a more detailed sort of diligence phase where we might bring in external advisors to that as well. And what we find with that is it can be really useful. So we brought in people to look at the tech side of the business often, and they often go on to work with the companies post-deal. I think the management teams find this really useful. That could be the same if we bring in financial DD firms as well. So, and often we'll bring in sort of one-man band, successful people in that industry to speak to the management teams. And again, they sometimes form a relationship and move forward with the business. So that's really the process through that diligence stage, then to final completion. The legals process sort of runs alongside, but I would allow 3 months on process. Next slide, please. So what we're looking for, I've just put some of the key things that we're looking for there. I won't go through every one. It could be a bit daunting if you feel like you've got to tick all of those boxes. You don't have to. I would say this is a seed to Series A fund primarily. It's quite early stage businesses. A lot of them don't have to be early stage, but there's kind of a 7-year rule, so it needs to be less than 7 years old generally. There are some exceptions to that. The bar is quite high. We do get hundreds of applications, even thousands of applications. What are we looking for? People, often you've got credentials in the sector that you're now building a business for. We see that quite a bit. Someone that's spun out of a big corporate and they're doing something in that sector, something innovative. Often they've had angel investment prior to coming to us. Often they're working with experienced non-execs and starting to set up their board. And really what we're looking for, if we just pick out the key elements out of here, is something differentiated. Why are you different from others, and how are you going to scale? And then really, we're looking for some early commercial validation. So as Dave said, it's difficult to fund a blank sheet of paper, an idea. We want to see that you've taken some sort of product to market ideally, and that you've got some early demand from customers, and some of your metrics are improving, so the customers might have come back, and you're seeing some upsell to existing customers. But you don't have to have a raft of customers, but a couple of good names always helps, doesn't it? I think to pique investors' interest. I think some of the other stuff is quite obvious there that I've listed, but just mentioning scalability. So looking at how are you going to achieve good margins and profitability in the longer run, and VCs and private equity funds look for recurring revenue as much as possible. So subscription revenue, we all want that Spotify, Netflix subscription payments going into perpetuity, rather than the kind of lumpy one-off projects where you have to keep going out to market and keep trying to sell. The recurring revenue is really key, if possible. But we understand that there's businesses are sometimes half recurring and half is kind of projects, so we're kind of used to that. But just to summarize, exceptional businesses always get funded, in my eyes. Whether if it's not Maven, it will be somebody else, and we're able to kind of reroute you and introduce you to angel groups, other VCs, if it's not quite right for us. Next slide, please. So just bringing this to life a little bit more, here's some examples of investee companies. in no particular order. So ITS is a business based in Chester, telecoms infrastructure business, putting cable in the ground in the telecom sector. We actually exited this business. We sold this business. Aviva, the big infrastructure investor, came in and put a significant amount of money into this business, and that crystallized an exit for us. It was a good, successful investment for MPIF in the region. My Digital, they do software as a service, payroll software and accounting software. So it's all about the change to payroll going more and more digital, and also the government wanting to move all the tax returns digitally as well. And that's based in Cheshire as well, and it's gone really well since we invested 2 or 3 years ago. That's a guy called John Whelan, who's the CEO, and he worked for a bigger business in this sector, and then spun out and has set his own innovative startup up. And he started with friends and family, angel money, and then came to us, and we put 1.2 million into his business in 2018. And then Blueberry, just to show the different types of businesses that we invest in. Blueberry is a life science business, so it's drug discovery. It's looking at new drugs in fungal nail infections, of all things. So yeah, we get to see the whole breadth of different sectors in this job. And then just passing to Dean, a couple of those are his portfolio. So Fazara and Stream Sensing, I'll get him to talk you through those.
Yeah, thank you for that, Gavin. I think probably just want to stress on, going back to what we're looking for in investing companies. I think, the key areas for me when I look at that, it's people, because fundamentally we're backing people to deliver a plan. So I think, the next limb to that is the plan. So I think it's key for all the, budding entrepreneurs, CEOs out there to actually, put together a credible plan that they believe that they can hit with investment. And I think that's always key. Sometimes it's better to under-promise and over-deliver, because sometimes we do see a lot of business plans, and I'm sure it's the same at GC Angels and David at the Growth Hub as well, that the growth is hockey stick, which is probably quite unrealistic. So I think from a credibility perspective, I think it's always important for management teams to think, is this a plan that we can actually hit? So I think that goes a long way with an investor. In terms of the other side as well, as Gavin said, there's a lot of capital out there and a lot of investors. So I think the important thing for management teams is, you've got to actually want to work with the people who you're talking to. And so I think, my view on that would be actually research the funds that you go and talk to, because at the end of the day, an investment process is a journey. It's a partnership. It's a bit like a marriage. And you've got to be comfortable with the people sitting opposite you, and you've got to want to work with them, because you probably spend more time talking to them than you will to actually your own wives or husbands. To be honest, it's it is a journey. So I think you've got to be aligned on that. In terms of 2 example investments, sorry for diverging there. Fazara, business originally based in Chester, recently moved to Manchester, is a workforce management solution. So very topical over the last 18 months. That business has experienced growth due to COVID. It's very much around bringing down all those spreadsheets that everybody has on the desktops for when people are going out to do jobs, etc. So I think it's really about digitizing the economy, really, and I think that was one of their key takeaways for the product. And that's why we're really excited to back the business. And then Stream Sensing, a very early stage business when we very first looked at this, effectively pre-revenue, a novel technology. So it's basically the rheology of fluid. So I'll give you an example. If you've ever had tomato ketchup in a glass bottle and you can't quite get the ketchup out and you don't quite understand, that's all to do with the rheology of the fluid in the bottle. And what the guys over there did was create a novel solution where FMCG businesses could actually measure the rheology of the fluid during the manufacturing process, so they could tweak the ingredients so that ketchup runs smoothly. because actually at the moment on the market, other than the stream sensing solution, there is nothing out there. It's a novel technology, and we've gone from doing a very small investment of sub 250k into that business to now to following on within 6 months to put a further 750k in. So we've got £1 million in that business. We initially invested in January at 250, and now we're up to that 7-figure sum. And I think that's credit to the management team putting forward a plan. It was a very large market they're attacking, but they did have that commercial verification from some of the largest FMCG players in the market. I can't name them for several reasons, but they are obviously based in the Northwest as well. So I think, from our perspective, we do back early stage businesses, and particularly when they've got that growth potential and they've got that market there to hit. So I think, they're two good examples of businesses that have been performing quite well over the last 12 months.
Thanks, Dean. Next slide, please. So I think that wraps up from our perspective, really. There's our contact details if you want to send through business plans, have any questions. Obviously, as we said, we work closely with Dave and also with GC Angels, with Sarah as well, across the team. So yeah, there's different ways of contacting us as well. And you can also apply direct through the website as well, the Maven website. But yeah, that's us. Thank you.
Okay, well, thanks very much, Dean and Gavin. That was a really, really detailed and excellent presentation. And you can now take a well-deserved rest and mute and switch cameras off. And I will now introduce, if you could pass me on to the next slide, Tom, and the next one, I think. There we go. Okay, we've now got George Richardson, who's the CEO and co-founder of Aerocloud. He's going to share his experiences of getting investment for the business. And I think I've got I'll introduce the business, George. You can correct me if I'm wrong here, but it's a management platform with artificial intelligence and machine learning that saves airports money. So with that introduction, I'll pass it over to you, and you can correct me if I'm slightly wrong there.
Thank you very much, Dave. I hope everybody can hear me and see me. Next slide, please. Thank you very much for having me. My name is George. I'm 122nd or one of 22 people and the CEO at Aerocloud. We provide airports operations teams with a platform to help them predict the future. We've been dubbed by Tampa International as by providing them with a crystal ball to help them see the future. We also work with airports as small as Orlando Executive and a couple of smaller airports in Europe. Our solution helps predict passengers and maximize the use of gates using AI and machine learning, which obviously results then in airports saving significant amount of funds. My presentation today is incredibly quick, and I am here to answer any questions that you may have about raising VC finance, as we successfully raised back in August of 2020, excuse me. Yeah, be delighted to answer any of your questions. So next slide, please. So what does life with money look like, I suppose you could say? In August of 2020, we were quite unique. Aerocloud was a business that was turning over about £178,000 in annual recurring revenue, which was quite unique for a company of 3 people in this space. We were founded in 2017. My co-founder had built and sold a business in this space in 2011. So we ticked all of the boxes that some of those guys from Maven suggested. We had quite an abnormal timing. This was the depth of COVID. So to raise equity finance, there's 2 types of VCs. VCs were either sat on the fence thinking, oh my God, what's going to happen through this difficult time? And then there are obviously VCs that decided to double down. And I think that the ones that doubled down did make significant gains. So fast forward to March 2021, it took us that amount of time to get the pace. So we got to 8 people, 5 or 6 customers at that point. And then fast forward to sort of October, November of this year, We are now at 21, 22, hiring about 2 people per month. We're at 12, 13 customers, and we're really motoring now. So you could say that we've sort of used our pre-seed and our seed funding effectively. And the measurements for this often is not necessarily profit, and some of the metrics around growth I'll come on to in my next slide, please. So investment, in my opinion, should be seen as rocket fuel. This is a connotation that I think is overused, but it's very, very true. We internally talk about the team at Aerocloud as boarding the rocket ship. We are in a very unsexy industry. B2B SaaS at enterprise grade for airport operations teams is not typically a sector that the majority of VCs actively look at. However, it is very exciting because there are many legacy incumbents that we've dislodged on multiple occasions now, and really gaining some traction. One thing that I think is firstly important when you are putting together your bid for investment is that the growth is often measured by hiring the best people that you can hire, and by acquiring customers and therefore nicking business off your competition. And what your investment is there to do is to spend money in order to achieve that. And profitability is not always the focus. There should be a plan to resort to profitability and to gain profitability over time. However, it is not the most important factor when growing your VC-backed business. If that's an important factor and equity is an important factor for you, then VC funding is not for you. VC is aimed at gaining significant traction very, very quickly at a high cost by employing the right people at the right time to acquire new business in that space. And the 5-year plan should revolve around growth opposed to the profit metric, which I think is a traditional organic metric that a lot of people look at, potentially look at a bit too much. Not saying that profit is bad by any means or stretch the imagination, but it's definitely a consideration. Next slide, please. So thank you very much for that short presentation and listening to me. I am very passionate about government procurement and complex B2B SaaS enterprise sales procurement processes. I know the VC market quite well. I think that we've raised from a group of the best investors in the UK, and I will look to announce our next round fairly soon with some significant names as well. I also know the Manchester scene or the scene of VC investment and deal makers and introducers and pots of money that are available to you through an angel network. So please, if you have any questions, I'd love to share with you some of my learnings and visions, and please connect with me on LinkedIn. Thank you very much, Dave. That's me done.
Okay, that's perfect, George, and really thanks very much for your time today. And it's really good to have some insightful actual experience of what the other guys have been talking about. So it's very difficult to actually think how much we could actually put into an event like this, but hopefully we've covered all the important aspects. George, you can now take a little bit of a rest, but I would imagine that I've seen some questions coming in already. So what I will do now is I will hand seamlessly over to my colleague Sherry Semper, who does the same role as me. She joined in May in the Growth Hub, and she specialises in growth business and innovation. So it will be quite often the case that we actually double up with dealing with clients, which we're quite able to do. So without further ado, we'll pass the slide on to the next one, please, Tom, and Sherry can take over. But we'll be around. If the panel can just be ready to come on and share their screens when Sherry asks the questions. Thanks.
Thanks, Dave, and thank you very much to the speakers for a very insightful session regarding investment. So we're going to come on. We've got 3 or 4 questions already. If you look at the bottom of your screen, there's a Q&A tab if you want to ask a question. But the first question that we've had: does my business need to reach a certain age before considering equity finance? And I think that really needs to go to the investors to start with, please. Dean, would you like to comment?
Happy to comment. So I think it depends on the sector really, because I think that there's if you're in a sector where yes, there's an opportunity, but it's a sector that there are quite a few participants. I think from an investor perspective, we'd like to see that the business is generating revenue, significant revenue. In terms of if you're trying to almost be a market maker or truly disrupt a market with some new technology, we will look at and do look at pre-revenue businesses. So I think it really depends on firstly the product and also the market that you're looking to attack. Really, I think that they're the two key distinctions.
Thank you. Sarah, do you have a comment on that?
Yeah, I'd also add to that, as something that Dean did cover in their presentation as well, is that it would be worthwhile. So obviously when you're looking at equity investment, I wouldn't suggest that be your first. There's looking at the grants as well. So when you've seen a pitch deck, and if a business has received a grant or at least has made an application for it, there's a lot more substance behind the founder and also the business to see, well, they are looking at the initial avenue. And once that grant has been accepted and approved, there's a lot more sort of confidence behind the business. So timeline, again, sector differentiate is different regarding the sector, but also if you've looked at the grants and if you've had time to make those adjustments and make those applications, then that also will support your case.
Thank you. George, do you have a comment?
Sorry, I was just on mute there. Yeah, I think my comment from my side is that your equity as a founder is incredibly valuable. And you'll only really realize how valuable this is upon exit, or if your business is lucky enough to get acquired or IPO. And the guys on the call are obviously looking to buy your equity at one price and sell at another. That's the business that they're in. So if you're a first-time founder, my advice would be to stretch your runway for as long as you can possible to prove traction, to your incoming investment and to yourself that you can do this. My personal advice is myself and Ian had about 6 months of runway that we had invested ourselves, which puts a stop date on, puts the pressure on us both to figure out how we're going to acquire that first customer, how we're going to build that first product. And then when you're going into that meeting with the VC from the start, you're then much more confident in what you've achieved rather than just raising equity finance for equity finance's sake. Because if you start to give away those percentage points, they could be incredibly valuable one day. And the difference between, you're flying on Ryanair and flying on a private plane, if that's what you're into. So I think that you need to really consider that. There's absolutely no profit in the pride of hanging on. And it's really cool, I think, to stretch that initial runway out to prove to yourself, which I think is the most important piece.
Yeah, I think just to add to that, actually, I think that's what you said there, spot on, George. I think from an investor perspective, if we can see that you've put your own money in, you're extending the runway, and you're looking to take it to market yourself first, it makes you a lot more credible. And from our, and then actually we don't mind paying up for a less risky investment in reality. So you don't mind paying a little bit more if there's a bit more certainty there, because from a return perspective, you're more likely to get a return as well. So I think it works both ways. It works as well for the investor, for the founders to take that bit more of a an approach of, look, I'm going to try and grow it myself as much as I can. Yeah, so I think that's a very good point you made there, George.
Yeah, just to add, all of that just means that the management team are more committed. They've bootstrapped the business. They've done the hard yard for a couple of years rather than just come with a business plan sort of 3 months in. I think just seeing that level of commitment that they can survive through probably the most difficult part, the early part, is just really important for us.
Great, thank you. On to our second question now. What are the costs involved in angel finance? Sarah, would you like to comment first?
Sure, thank you. So there is the costs when you're going into angel and finance. Obviously, there's a little bit of the equity is one potential cost. Obviously, it depends on how much control you'd like to have over your business and whether or not, you know, you need a NED on the board, or the kind of individuals that will have a contribution to the direction of the business as well. And then there's also the financial cost as well. So any sort of investment that goes into a business on our side gets a 5% introductory fee. So that's from the GC Angels perspective. That's, I think I'll pass on to Dean and Gavin for further.
Okay.
Do you want to take that one, Gavin, or do you want me to?
Yeah, I think often businesses perhaps end up sort of conceding too much equity to angels. I know sometimes they're in a tight spot and they need some funding, but often we see angels coming in at like really low valuations first round and take a big chunk of equity, and sometimes it's a little bit difficult to recover from that. But you know, you've just got to make a judgment call, I suppose. If that's the way to propel your business forward and the only way, then so be it. Just got to be a little bit careful, I think, and perhaps just take the least amount of money possible to get you to your next milestone. Don't know whether others have seen that around the table.
Yeah, I think as a general rule, I think if you're looking at angel, a 10 to 15% dilution should be about the right level. Seed 15 to 20% again, and then Series A 20% potentially, or 17 to 20%. I would like to maximize on Gavin's point. I think that angels are really great, right? For that first 50, 100K, especially if you don't have a cash injection yourself that you're able to put in. Let's say you're leaving a 35, 40,000 pound job and your overhead is X and you don't have a runway of 12 months. I was fortunate in the sense that, you know, I had some free office space and I sort of clobbered together my 6 months from a prior life. But everybody's not in that situation, right? So angels are really key, but please don't be giving more than 15, 20% of your business away, and make sure you're getting paid 50 to 100 grand, and make sure you got absolutely zero overhead. Rely on using your lawyer's office included in your fees if you need some meetings. Use a free Wi-Fi call in all the time. Buy yourself a second-hand laptop. Really think cost effective.
Thank you. Thanks for that, which leads us nicely into the next question. How do I know the value of my business? Who would like to kick off? Dean, would you like to kick off?
I think it'll be good to get George's view on this as well, because I think it's always there's always two views on the value of your business. I think you know, it depends on the stage of the business, because I think, you know, from an investor perspective, valuations can get very frustrating, because I think, you know, this goes back to the advisory community as well, because I think a lot of advisors will look at comparables that are listed on the stock market and say, well, a business that has got ARR, it should be 25 times or 30 times ARR. But in reality, they're looking at businesses that have got, you know, 750 people, have been trading for 10 years, you know, have got a reputation, you know, they've got metrics that you can measure, so you can look at customer churn, you know, customer acquisition cost. So I think there has to be an element of realism. And I think in reality, I think if you look at it from a percentage basis, as George said earlier, that is probably a better way to look at it if you're a founder from a very early stage business, because it's about how much are you willing to give away to get the funding you need to get to where you want to go. I think we do look at market comparables. We look at fundraisings in the sector to see what stage of similar businesses raise money at in those sectors. But I think the other thing to look at as well from a valuation perspective, a fundraised valuation is often very different from an exit valuation. So you'll see fundraisers where you might have, you know, 5, 6, 10 times even, but actually on an exit, when a corporate acquirer is buying that business in 3 or 4, 5 years time, they actually will probably only be paying 4 or 5 times. Because I think it all depends on the type of business as well, and what is your true nature of your business. We look at businesses that really are truly ARR. So, for example, George, your business is an ARR business. There's not much to say that it's not. Whereas other businesses, there's an element of it's transactional revenue. And you do see some people, you know, advisors in particular, try and push it to say, well, it's still, you know, it's annual revenue, so that should be treated as recurring revenue. So there's always a bit of a bit of a debate where you've got to understand, should your business be valued from a revenue perspective, or should it be valued from an earnings perspective? And a lot of that goes down to margin as well. So if you've got your product that's 90% margin, that's more than likely to be a software business. But if you're looking at it from a 10, 15, even lower percentage of your margin, it's an earnings-based business, the valuation you should be looking for. So I think it's just getting that balance right. But I think particularly at the early stage, you should be thinking, well, what percentage am I willing to give away to get to where I need to get to?
Yeah, I'd just add to that. There is, I think, maybe another way to do it from the founder side, which is that you get your data room in order. And a data room in simple terms is your market size, how you're going to attack the market. It's kind of the extension of the business plan that Dave mentioned at the first part of this webinar. And then what Aerocloud did, I can only tell you what I've did, and I've only raised VC funds once, so I can only really tell you of that experience. But my way of doing it was to invite the investor to my pitch, and then let them effectively help me build a valuation. And you soon see then that the competitive tension in the market will drive valuation, and then you'll result in what the price someone's willing to pay for your equity. And at that point, you've got your wits about you and you understand what sort of valuation you want at that point. These guys are in the business of funding businesses past they want you to take more money, right? They want you to take past seed into Series A, et cetera. They're in the business of that. So they're not going to allow you to fall short. I know that Maven mentioned that they want founders to have X amount of runway so that they can actually give the business a proper shot. In my case, for example, with large enterprise sales, my customers pay me 5 years up front in some cases, and ARR values could be over $150,000, £120,000. So if I miss one of those checks in a quarter, for example, that's a huge problem when I've raised my overhead to 22 people. So I need that runway and I need that dialogue with the investors, and that has resulted from raising the proper amount of money at the start. So make sure that you know what you're going into, and let the market feedback on your valuation. And one thing I would say is that there is more money in the market than there are opportunities, I think, or good opportunities at the moment. It's definitely a equity sellers market opposed to an equity buyers market. So there's loads of finance out there at the moment, and drive that competitive tension and get these guys competing against each other to drive the valuation of your business up.
Thank you. Sarah, do you have a comment on that question?
I think everything's been covered there, and I do really think that having George's perspective on this is definitely very handy, because it's a first-hand perspective. He's gone through the positioning, so I'm taking a lot of information from George as well here, so thanks for that. But yeah, no, nothing to add. Thank you.
That's great. Dave, go ahead.
I'd just like to say I'm going to blow a lot of smoke across the panel here, but I think in terms of actually trying to get a handle on how to value a particular early stage business, that that last 5 minutes should be put out there, guys. Really proud of yourself there, because I think that really does cover everything. I mean, all I would say is, I'm sure everybody watches Dragon's Den. You've just got to see, is it Tuka Sullivan? I don't get out of bed for 1 or 2%, and I think that's the only thing I'd put a reflection on is, but like you said, don't give it away. So I'll go quiet for a bit now. Well done.
Okay, we're moving on to the next question now. This is one for George. How easy or difficult was it to raise the finance, George?
Yeah, I got this question before, so I've done some sort of detailed notes on this. So in my particular case, we raised in the depth of COVID, and I would say that it wasn't necessarily easy, but then I would counter that on saying that Aerocloud was an abnormal business. So it took us 3 months. We had heads of terms, which is the first stage of your investor showing you that they're serious. They will send you a heads of terms. So this is when the value starts to be put on your business. You will get a heads of terms, which is usually a 1-page document that says we are prepared to buy X% of your business for X amount of money. So we got a few of those, and we didn't actually drive some of the competitive tension that I actually just alluded to. And in hindsight, I wasn't necessarily in a position to, because the market was quite interesting at that point. So what I went for is I went for the board member that I wanted, the experience that I wanted. And given that I'm in a very niche sector, if you like, that wasn't hard to come by. So we picked a lead investment by Maven Capital. And I picked the board member that we wanted in Chris Smith. This was really important for me as a second-time founder, and my co-founder as a second-time founder, with the limits that we had in our prior business was the scaling above 10 people. So for us, he was able to offer us that. It wasn't easy, and I think that we didn't pick the most competitive offer either. We picked the people opposed to the money. Aerocloud was generating money. It was profitable at 3 people. Admittedly, that's not that impressive when you look back at it now, but in seed terms, it is. And we knew that the industry was going through a very rough time. You know, a lot of people apportion us to be in the travel sector. We're not in the travel sector. We're in the business of selling airport software. So airports are often government backed in the US or privately owned huge businesses in the UK, for example. And we knew that our timing was now. And when your timing is now and you've built a story about why your timing is now, you are genuinely in the driver's seat and you can pick some of your options. So it was very difficult. We had an easy run. What I would say is that in that time, valuations hadn't have gone as crazy as they have done now. And I'm in a process now, personally, of reflecting my seed into my next round of funding, because I think the valuations have gone higher of businesses like Aerocloud as of now, as this money surge has come in. So prepare yourself for 2 or 3 months, I would say, but make sure that you've done all of the work that you think the investor is going to do in your data room, compile your market reporting. That's going to be the biggest thing, and then give it to them and give them an opportunity to ask you the questions back. And a really top tip, I would say, under raising the investment in this competitive landscape is you will get frequently asked questions, and you will have to do your rounds of your 20, 30 minutes 15 times a day for 2 weeks, condense it into 2 weeks, and make sure that you written down all of your frequently asked questions and publish them in the data room. So the investor then has to do some work before they meet with you. So you're only answering new questions each time. And this was absolutely imperative for us. So yeah, I know that's not necessarily a straight answer to your question, but there's some top tips I think that can actually add some value.
And just to follow on from that, George, how have you actually found and got used to someone coming in from an investor into your business and being involved in your business?
Yeah, I think personally, myself and Ian operate better when we're around people that are better than ourselves at certain things. The reason why we picked the board member that we did, the reason why we hire C-suite, the reason why we hire lead developers, or salespeople, etc., because they're doing elements of the business that are better than us. So for us, the investment was imperative to be able to hire those people. When you've launch your investment news, people are more attracted to your business. Better people are attracted to your business. You're not having to sell them on the dream and only pay them in equity and free coffee, for example. So getting used to having someone in our business was something that we wanted. And the experience of scale is something that we needed. So there was a want and a need there. And still at the same time, my board is only 3 people. So it's me, Chris, who's the investment director, and my co-founder, Ian. So we still have a lot of control in our business, and we're given every ability to run as fast as we want. So I wouldn't say there's any negative to my current investment. I have heard of nightmare stories. There are nightmare stories out there. And I think it was Sarah that said that you need to vet the people that are coming into your business and ask them for the references of the business, businesses that they've invested in prior. It's absolutely of the utmost importance that you do this. You need to run a TripAdvisor on some of the bad investments. Why did they go wrong? What was Dean and Gavin like when it wasn't going so well? Because investors are really lovely when it's all going well and it's all the nice dinners out and let's go down to London and let's do all this stuff. But what actually really happens when the chips are down? How much of a crocodile are they? And I think that the style of investment now is much more founder focused. The vulture capital term has definitely gone away to a certain degree, but there are those horror stories out there. So do your homework on the people that are coming in to take a slice of your pie. You're going to be working with them for a bloody long time, so they need to be the right people. And And then the other thing is reporting. You are going to have to be asked to report. That's going to be in your new articles and shareholders agreement, that you have to report to your investment director for certain metrics that their fund look for. So Gavin and Dean will have certain metrics that they need to report to their money men and women that are funding their fund. Don't forget, they're in the business as well of raising money like you are. They're raising money for their fund, you're raising money for their business. So they need these reporting metrics, and those need to be as strenuous to keep you in line, and you need to want to do them to keep you on the best path. But at the same time, they can't be distracting to doing your sales and your business. So those are the key pieces I think that need to be a consideration. Other people is the best thing in your business if they're the right people. If they're bad people, you're going to be chasing them around. You're going to be reporting on stuff that is totally irrelevant. And when the chips are down, that's when you need really good people in your business, because they are going to go down one day. You are going to have those issues one day. So please make sure you pick your people wisely.
Thank you. And now back to a wider question. How do I begin the process of asking for investment? Gavin, would you like to kick us off on that one?
Yeah, I think I touched upon some of that earlier, really. I think the couple of key things is get your business plan and your strategy together. And I think what founders often miss in the business plan is the history of where they've gone in the past and how they've perhaps grown and developed the business in the past. Sometimes it's all about the future. It's nice to know a bit of both, really. What have you done in the past, and how's it moving forward, and how you're going to do that? In terms of how do you go about it, as I said, you can apply directly on our website. Often businesses go through accountants, lawyers, corporate finance that have good connections into funders. So that would be a good way to get a warm introduction, I think. We work, with most of the advisors in the Northwest region. And again, through the Growth Hub, through GC Angels, because there is that ecosystem of moving towards institutional investment. So I think they'd be the way in. A warm introduction always helps, obviously, but we do look at everything that comes through direct as well. We've got a big team, so we can do that.
Sarah, have you got a comment on this?
Yeah, sure. So following on from Gavin, again, warm introductions are ideal if you can get them, but if you can't, at the end of the day, just an email or a LinkedIn or however you wish to go through. Going through one of the previous things of when you're pitching and when you've got your deck, when you're sending that through, make sure you're honest on your deck. And when you've spoken to people, you have to make sure that what you're saying is true and honest, because what come across many a deck sometime that they've said, oh, these are my advisors and you've got XYZ institutional investors, and then when you kind of call them up on it and say, well, how far has this gone, what's the conversation going on here? Oh, I had a phone call with them a few months ago. And then at the end of the day, we all speak to each other. The network is there, be it across the Northwest, be it across the specific cities. We all happen to know each other, and it's really interesting to see one business come across, and especially through these warm introductions, if you say, oh, I've come across this business that like an introduction here, oh, I've heard about them before. So if you can get into these networks, speak to your advisors and say, put me through to anyone and everyone that you think may have an interest, even if it's not specifically for funding, investment, even if it's just for a chat and a little bit of support, a little bit of background, some experience, information that they may have for you. Every single conversation you have is an opportunity to add someone to your network and to learn something that someone else has gone through, or something that may or may not come across in your future. You may be able to utilize it. So when you're getting ready to speak to someone, when you're looking for investment, make sure you've got a network around you and you're doing everything you can to expand that network as well, for the positive, obviously.
Dave, you wanted to come in.
No, I'd just say the simple answer to that question is get in touch with us and talk to me. We're free, and we'll be the first port of call and the the first opportunity to talk this through, and I'll just introduce the guys at the appropriate time